Welcome to the Deep Dive. Today, we're digging into something pretty fascinating. The U.S. dollar. You hear a lot of talk, a lot of political noise about currency, but what's actually going on behind the scenes? So our mission, as always, is to really get into the source material. We're looking at a piece from the Economist, feelinggreen.pdf, to pull out the surprising facts about how the dollar has been doing and what it all means. And right off the bat, there's this pretty bold claim in the source. The idea that Donald Trump has actually damaged the dollar. Is that true? What does that really mean for you, for the wider economy? The source itself asks, how badly will it come clear in the next crisis? So yeah, let's start unpacking that. Okay. So the source kicks off describing this initial shock among investors. It seems like specific White House comments, that rhetoric about currency really spooked the market. You get that sense of surprise reading it, don't you?
Oh, definitely. It's quite vivid. The source points to a specific instance, where Mr. Trump apparently told the Treasury and the Fed he was thinking about slapping a big tariff, maybe 10%, maybe even 20% on European imports.
Wow, 10 or 20%.
Yeah. Now, he did change his mind later, but that initial signal, it landed. The source even uses this phrase, that Trump was feeling green about intervening in the currency markets. Sort of suggests he was ready to actively push the dollar's value around.
And we saw a real impact, right? A measurable one.
Yeah.
The dollar fell, 8% against other major currencies since June? That's a big move.
It is a significant drop. And when you see that kind of number, it immediately signals nervousness, a rapid rethink of risk, really.
So people got worried.
For sure. The source mentions Treasury Secretary Scott Bessent found it worrisome, especially since he had perhaps expected something different. And the market reaction was pretty clear-cut. Investors started moving out of dollar assets pretty quickly.
Moving out how?
Well, a couple of ways. Some just parked their money, waiting for better returns somewhere else. Others made a more direct move, shifting into gold. That definitely signals a lack of confidence, at least in the short term.
Okay, but here's the part that kind of makes you scratch your head.
Yeah.
Right? The paradox. Normally, you'd think tariffs would help the dollar, wouldn't you?
That's the conventional wisdom. Yeah.
Like, if U.S. companies buy less stuff from abroad, they need less foreign currency, so demand for dollars goes up, dollar gets stronger. Basic economics? Sort of?
Right. But that's precisely not what the source says happened here. It seems investors didn't just hold back on buying foreign stuff.
So what did they do?
They actually went out and bought foreign assets, which of course means selling dollars to buy those other currencies, weakening the dollar.
Huh. So the reaction completely flipped the script on tariffs.
Exactly. It really challenges those standard assumptions, and it makes you ask, okay, why? Why did the market react in this, unexpected way?
So that's the big question then. If it wasn't just the tariff talk doing the predictable thing, what else is going on? What are these deeper factors making the dollar seem vulnerable?
Yeah, that's where it gets really interesting. The source lays out several things working together. It's not just one factor.
Okay, like what?
Well, first, there's the whole interest rate situation. The source calls it the modern state, basically. American interest rates are relatively lower than in some other places right now.
Okay.
So naturally, money flows towards currencies where you get a better return, where rates might be rising more. Makes sense, right?
Yeah, investors chasing yield. Classic.
Exactly. And that ties into the second point, this idea that the dollar's role as a safe haven is maybe eroding.
How so?
Yeah.
It's always been the go-to in a crisis, hasn't it? The liquidity play, as the source calls it.
Traditionally, yes. Park your cash there because it's stable, easy to trade. But it seems that perception is shifting. Investors aren't automatically running to the dollar like they used to.
Interesting. So lower relative interest rates and maybe less of a safe bet than before. What else?
Then there's the simple fact that foreign assets are just offering better returns overall right now. So capital is being drawn away from the U.S. for that reason, too.
You can see that in the data.
Yep. The source points to the trade-weighted dollar index. It peaked back in April, right when those Trump tariff announcements first hit. And then it plunged. Investors basically shed cash, shedding dollars. It shows how the dollar's value against, its main trading partners really took a nosedive.
So the tariff talk did have an effect, just the opposite of what theory might predict because of these other factors.
It seems that way. Plus, there are these broader worries about fiscal policy. The source even mentions things like Liz Truss's budget issue in the UK.
How does that connect?
Well, it's an example of how threatened fiscal meltdowns, even elsewhere, can make markets jittery globally. It shows how interconnected things are and how worries about government finances anywhere can sort of spill over and affect confidence in major currencies like the dollar.
Right, general unease about stability.
Mm-hmm. And while some people might say, oh, it's just about relative economic growth, the source actually finds the evidence for that is mixed. It doesn't seem to be the main driver here.
So growth differences aren't the full story.
Doesn't look like it. Another really interesting point is about volatility. Dollar volatility used to be a pretty good proxy for investor fear, right? It soared back in April.
Yeah, market panic often meant a stronger dollar as people sought safety.
But now the source says that link, that correlation between dollar volatility and financial instability is weaker. It's less correlated.
So even when markets get choppy, the dollar isn't behaving in that same old predictable fear gauge way.
Seems not. Which again points to a shift in its fundamental role. It all paints this picture of, global capital flows changing, money coming into the U.S. seems to move inversely with the dollar now, and there's this broader global shift towards taking on more risk on assets.
Wow. Okay, so pulling that together, it's not just one thing. It's interest rates, it's maybe the dollar losing some of its shine as the safe place, its better returns elsewhere, fiscal worries creeping in, maybe even volatility acting differently. It sounds like a fundamental rethink of the dollar's place in the world is underway.
I think that's a fair way to put it. It feels like a deeper recalibration, not just a temporary blip. Global capital is looking for returns, maybe accepting more risk, even if there's underlying uncertainty.
Okay, so that's the complex background. Bringing it to today and maybe the near future.
Yeah.
What does this actually mean for our listeners right now?
Well, the source highlights a specific date, August 1st. That was apparently when U.S. effective tariff rates were set to go back to the same levels that caused that dollar drop back in April.
So potentially triggering a similar reaction.
Potentially. The source is definitely cautious. It says something like, dollar watchers will probably not need to wait too long for what an opportunity, which sounds a bit ominous.
An opportunity for what, though? Volatility.
Yeah. It implies change, certainly, and it adds that they are probably not prepared for what comes next. So it suggests more surprises might be in store. Uncertainty seems to be the main theme.
Okay, good to keep in mind. But you mentioned something reassuring, too, about mortgages.
Yes. Important point. The source does explicitly say that, based on these specific dollar movements, no mortgage interest rate spike is expected. So that specific worry, at least according to this analysis, isn't on the immediate horizon.
That's definitely good to hear for a lot of people. Okay, so wrapping this up, it's really clear that figuring out the dollar's value isn't simple, is it? It's this tangled mix of politics, economic theory, market psychology.
Absolutely. And often, as we saw with the tariffs, what seems like common sense doesn't quite play out as expected in the real world.
The conventional wisdom gets challenged.
Constantly. Which leads us to maybe a final thought for you, the listener, to chew on.
Go for it.
Well, the source suggests dollar watchers might not be ready for what's coming next. Given how complex and frankly surprising these interactions between politics and global economics are, how might your own understanding, your own framework for thinking about traditional financial signals need to change? How do you prepare for the unexpected in a world that seems to be shifting so fast?
That's a great question to end on. How do our old mental models hold up? Something definitely worth thinking about. Thanks for breaking that down for us.
My pleasure. It's a fascinating topic.